Hi, it's Warren Berger with Luminary Financial Advisors. So whenever we're making decisions about our investment portfolio, we always want to be data-driven, pragmatic, and try to leave emotion behind. That's easier said than done in a lot of cases, especially with all the influence that we have from social media or just the press in general, where they try to hype up markets that are moving higher, and they try to panic everyone when markets are moving lower. And so it kind of goes along with, I think, the two emotions that are the most destructive when it comes to making decisions in your portfolio, and that's greed and fear. And they're destructive because, one, they're so prevalent. So many people will make a decision based out of greed or out of fear, but also it's repeated. So you'd be shocked at how many times I'll see people make the same mistake over and over again because they let their emotions flow into their decision making. So let me talk a little bit about greed and what does greed look like when it comes to investments, and that can kind of take two forms from my perspective. And one is that you've had investments that have performed really well over a period of time. You've become emotionally invested in those, in the success of those, whether it's equities, real estate, whatever it is in your portfolio that's done well, and you continue to believe that they can only go higher. Instead of taking some profit at some point, taking a step back, understanding that markets generally move cyclically and that there will be a top. And so what happens is people stay invested in these things, and they never take their profit. The market moves, and their greed in that situation kept them from being profitable. The other is that fear of missing out, FOMO, as everybody says, and it's that idea that you're watching people around you making money, or the press is hyping up the latest new fad. GameStop is a great example, and some other stocks recently. The funny thing is the guy that's working down the hall from you, or your neighbor who you run into at a soccer or lacrosse game. People generally tend to only talk about the winners, right? They only want to talk about the stocks that they bought that were a big hit. You very rarely hear about the losers, the ones that they bought that they lost money on. And so it starts to give an impression that everybody around you is doing so much better than you are. And so that fear of missing out, I have to get involved in this. What it tends to do is have people jump on that bandwagon, and once you've heard about it or it's become that popular, chances are you're near the top, and it's become maybe bubblish, and oftentimes you'll find people jumping on at just the wrong time as the market's about to turn. So that's the greed component. The fear component is very similar, just the bottom of the market, and so it's that panic that is induced by the press, by people around you, that worry, that fear that you're going to lose everything that you have because the world is coming to an end and the sky is falling. But the fact is, if we look at the markets over time, from the 1900s to now, markets have always gone up. Now, does that mean that they're necessarily going to go up in the future? No, but we've seen every time that there was a crash, these made for really interesting buying opportunities in the market. So the idea to get around that is to just make sure that you have a plan, that make sure that you have an investment plan in place that takes into consideration the amount of risk that you're willing to take in your portfolio, but also the amount of time in which you're going to need that money. So if you have 30 years out, you're willing to take a bit more risk in your portfolio, and you're willing to absorb some of these shocks that will happen in the market, the ups and downs of the market, because ultimately you're counting on the historical precedent that's been set that markets go up over time, even though you'll have, market downturns, and then you have those discounted opportunities to buy during those downturns. As you get closer to your time horizon, that's when you start backing off the risk. That's when you're less willing and able to absorb those shocks to the system. So you start making changes to your portfolio over time to accommodate the fact that markets will have a downturn, and when you need cash to have available, that you have it there. But ultimately, what you want to do is just make sure that plan is in place so that when things are happening in the news or when you're seeing the newest fad, you don't have to look at that in a way of like, hey, I'm missing out on something. You're actually just looking at it saying, hey, that's just a blip on the radar. But my overall plan says this. My overall plan is actually counted on the fact that markets are going to go down. My overall plan has counted on the fact that we're going to see bubble-ish markets at times. And even though I might not capture all of that, I'm likely capturing some of it. And that's going to be enough because ultimately the plan is about achieving goals. So it's not just about achieving money, it's making sure that the money is there to pay for the goals that are most important to you. So these are just a couple of points that I wanted to make when it comes to investments so that hopefully when you're thinking about your investments, you're not letting the rest of the world around you influence what you're trying to achieve. So I hope that's helpful and have a great day.